The markets are crazy right now. You got the Iran war, it's ping-ponging up, down. If you're a retiree or someone looking to retire, you're probably thinking, what should I do? Well, there's some interesting things happening. In light of the markets doing what they're doing, one thing is happening, and that is guaranteed interest rates are going up. So when you think about income and you think about retirement, you think about a set paycheck that you want to earn for the rest of your life, but you also have concerns about running out of money. And if you use the stock market, if you use traditional retirement accounts in the market to draw down your retirement, you're in big trouble, especially right now. Today we're going to talk about three things: guarantees, and guarantees. But let's be more specific. We're going to talk about guaranteed growth on a tax-deferred basis. We're going to talk about the rates you're getting today, which are north of 5%. As a matter of fact, right now you can guarantee 6.5% on your money. Think about that. That's market-based returns. Not only that, you could then create an income stream that is guaranteed to never end, and part of that income could fund your private banking system so you can finance and take back all of the banking functions in your life. We're going to cover all this on today's episode, so let's dive in. Welcome back to Wealth Webinar. Thanks for joining us today. Today we're going to cover a really important topic, but before I get into the topic, I want to just preface a few things. Anyone been watching the news? So today is May 20th, 2026, and if you watch the news, it's all about, well, there's a lot of things, but it's about the Iran war, it's about the Strait, it's about oil prices, it's about inflation, it's about all these things. And if you really kind of boil it all down, what it's doing is it's creating massive turbulence in the stock market. Today the markets are up. Yesterday the markets were down. If you are somebody who is invested in the markets, has money in a 401k, a retirement account, you're probably sitting there about ready to pull your hair out because it just is insanity. And you know what? I get it. The stock market is volatile. It's very unpredictable right now. There are so many things happening all at the simultaneously the same time that I know when you look at your statements or you look at your accounts, you're probably like, well, I don't know what that's going to mean for our portfolio. And a lot of you probably don't even look. But here's the thing. There's an interesting dynamic happening right now. This is something that's not going to last, but we're going to talk about it a lot today. And that is guarantees. Okay? They're in my career, which in less than a couple weeks, I will have been in the financial industry, okay, for 23 years. I'm dating myself. But in 23 years, I've never seen this happen. And here's what it is. When you see on the news or you hear that yields on the treasury bonds are high and climbing, that means some good things. That means, okay, there's a lot of bad because that means mortgage rates are higher, car loan rates are higher, credit cards are higher, but it also means guaranteed interest rates on fixed products are higher. So what we're going to talk about today, we're going to talk about getting off the roller coaster ride. We're going to show you some options to literally put a guarantee behind your money. Guaranteed interest on your money. And we're going to show you how to do that. We're going to show you how the insurance companies do it, how the banks do it. I mean, the banks are going out there and selling you CDs, and a lot of people are clamoring to these CDs, but they're probably not the best place. CDs can be a terrible place to put money because they can have, number one, it's a probatable asset. So look that up. Number two, you pay tax on any interest to earn. Number three, you lock up liquidity because if you take the money out, they take the interest back. There's a lot of bad things. And CDs right now are not paying very high interest rates, in contrary to what we're going to talk about. So when I think about the stock market, okay, it always brings me back to the studies that Craig Yenny has done. Now, Craig, when you do all these studies, you usually will take a snapshot in time on the S&P 500, and you'll say, okay, over this 20 or 30-year period, it is averaged a return of what? What is that return typically? And if you don't remember, just roughly.
It depends on the time frame, but it could be 7, 8, 9, 10 in that ballpark, depending on.
Let 6.5%, 7, 8%. You'd all be pretty happy with those returns. But to get those returns, you got to ride the roller coaster. But what if you didn't? Literally, what if you could get 6.5% guaranteed on your money for a period of time. That is one of the things we're going to talk about today. So I just want to get that right out of the way. This is the first time I've seen this in a very long period of time, where you can get these kind of guaranteed rates in an account that grows tax deferred, in an account that bypasses probate, and you can use retirement dollars too. It doesn't matter then because that retirement accounts are tax deferred, but I'm just trying to tell you that this moment right here and right now might be a time to think about a pivot. A pivot like a Warren Buffett pivot, where he went from being mostly all equities to now a dude's got like $380 billion just sitting on the sidelines in cash. But in cash doesn't mean he's sitting in bank accounts. He's got cash equivalent types of vehicles. And we're going to talk about fixed interest vehicles today. You've probably heard the word annuity before, but if you've listened to Fisher Investments, they are saying annuities bad. And I agree with Fisher Investments. They're talking about variable annuities. I hate them. I think they're terrible. They're high fee. They've got investments that can go all over the place. But what I'm talking about is something you don't hear much about, fixed annuities. They're called MYGAs, okay, which are guaranteed to pay you a fixed interest rate for a period of time that you pick. That's all we're going to talk about. There are no fees on the fixed annuities. You pay no fees. So I love that somebody said, oh, the return's probably more like, 4 or 5% after fees. The MYGAs, the fixed accounts, there's no fee, okay? There's no fee. So that's a really nice thing. And I have not seen these kind of rates. But here's another thing we're going to talk about. We always talk about you becoming your own banker. And we're not going to disappoint you today. We are absolutely going to cover being your own banker. But here's something that comes up all the time. We come across clients on a weekly basis that will say, hey, listen, is there an option for me to just take a chunk of money and just put it in one time and be my own bank? And the answer is yes, we can, but it's not direct into the specially designed and engineered whole life. Because if you took a giant chunk of money, put it into a policy, you would mech the policy. Even if you went into a single premium policy, which is a policy, it's a whole life policy that can be specially designed and engineered, but it's designed and engineered where it can take a single premium, and that's it. You never put another dollar into it. You put the money in once and you're set. But the problem with most single premium applications is you mech the policy. You make it taxable, meaning any of the gains you make in the policy over time, they're going to become taxable. Taxable like your CDs, taxable like your money market accounts, taxable like your high yield savings accounts, or whatever else you want to throw in there. But there's a breakthrough that we're going to hit today. What if we could show you a way where your money could work twice, your money could earn twice, and you could have exactly what you want, which is a tax-free, account, a specially designed and engineered whole life account that you only have to fund one time with a chunk of money. We're going to show you how you can do that, but we're not going to just do it the way we would normally have done it. We're going to do it into a vehicle that's going to benefit from all of these high interest rates like I've been talking about. And we're going to show you how you get your cake and you get to eat it too, because you're going to have a tax-free banking system like we always create, but you don't have any future obligations to put premium deposits in later. We get this question all the time. I typically don't talk about it a lot because it's rare, but it's just become, it's become too obvious that people have this scenario. They have the sale of an asset. Maybe they sell a business. Maybe they had a windfall and an inheritance, and they got this chunk of money, and they know that they got to do something with this chunk. They know they want to become their own banker, but they're like, I don't want to commit to anything, year over year over year. I just want to put money in one time. Can I do that? The answer is yes, but today, the difference in that yes answer is you can do it in a completely optimum state, because the interest rate environment on these guaranteed fixed annuities, paying what they pay out, enables us to do something we normally would never be able to do. And these are the things you're going to hear about today. You're going to find out how the annuities can solve problems for some of you Some of you that want guarantees on your retirement assets. Some of you that want guarantees on your money. You can also solve another problem. Some of you want guaranteed income for the rest of your life. We can solve that problem every day of the week. We can provide you a strategy that will give you an income for the rest of your life. And when you heard the interest rate you're earning on that money, you would say that is impossible. But today, given the interest rate environment where we're at and the uncertainty out there in the bond market, you can actually get these crazy interest rates guaranteed for the rest of your life that all relate to a monthly check that shows up. Imagine that. Every month, you're retired or you're getting ready to retire, you make one change, you put your money into one account, and every single month on a very specific day, your choice, you get a check. And that check is exactly how much you wanted it for every day for the rest of your life. And here's the things you don't have to worry about. You can never run out of money. Those checks can never stop. The amount on those checks will never, ever change. They will be the same amount. And if you die, you can set it up so that those checks continue on for your spouse, either for a period of time, because, hey, listen, statistics would show if you died today or I died today, our spouse, our loved ones, they're going to move on. It might take a year, it might take 3 years, 5 years, but statistics will show they're going to move on. So if you want to provide an income stream for your spouse, you might only say, hey, listen, I'm giving her 10 years. She's got 10 years to find another dude to cover her expenses because she's expensive or he's expensive. So yeah, that's your choice. But we can structure it so that that income stream continues on for your life. It continues on for your spouse's life. We can even make it so that it continues on or gives a chunk of money to your kids. So again, these are just some things that you may or may not have ever heard about. We felt it was incredibly important to talk about them today for two reasons. Number one, the interest rate environment, the environment we're in right now, volatility in the stock market, fear off the charts. Uncertainty is off the charts. Investor sentiment is not good right now. People don't know what's coming, but they see all this stuff like the Iran war, the stalemate, the threats, everything else going on. They see the stock market ping-ponging around, and they're sitting there saying, how would I ever retire given the circumstances? Well, you wouldn't until you get off that train and into the guaranteed train. And today, I got to tell you, in 23 years, I haven't seen it this good. So let me just start real quick, okay, with the transformation, because every time we do this, every time we do these webinars or we talk to people, and we talk to hundreds of people every single week, we find that people leave money in traditional bank accounts, okay, because they just don't know what else to do. We find that people chase market returns by taking risk in the markets, and their financial advisors are investing their dollars. We find that every single day. We know that people are scared right now. Well, they're scared of the volatility and everything else that's happening, and they're worried, very, very, very worried about retirement and their retirement income and whether they're going to have enough money to retire, whether that money is going to last long enough, whether or not if they have an unforeseen circumstance happen, whether their retirement nest egg is going to be wiped out. We hear this every single day. But I know for one thing, every single person we ever come across is looking for predictable, guaranteed income or predictable, guaranteed growth. And when we layer in this be your own banker strategy with everything else, we get a couple other things. We then get to control volatility in retirement portfolios. Let's call it a retirement buffer. We also get to take back control of the money that we give away today. So here's the thing. I want to try something different. Before we get into the guaranteed fixed accounts and the interest rates that they're paying, which I'm just because some people don't make it on here long, 5.6% guaranteed for 3 years, 6.3% guaranteed for 5 years, 6.5% guaranteed for 7 years. Those are the guaranteed rates today on any amount $100,000 or more. The rates are still super good for less than $100,000. I just had to pick one to choose from, and this company had those rates on $100,000 or more. So just a teaser. But let's talk about the infinite banking concept. What is it? How does it work? And here's the easiest way I'll explain it. If somebody wanted to buy a car and they wanted to pay cash for it, even though there's no cost for this webinar, we do 6 webinars every week. There's no cost for any of them. We do charge for like our 3-day virtual events and our live events, but these we've done free for now 7 years, I believe these have been running every single week. And we very much appreciate all of you because nothing in life is free. You all know that, right? You're like, well, this is free. but it's not. Because you're giving us your time. This webinar goes for an hour and a half. You're going to give us an hour and a half of your time. How much is your time worth every single hour? Now, don't answer that because it's a trick question. If any of you put any dollar amount, you're wrong. Your time is, it's not, you can't put a price on it. It's invaluable. So you are indeed paying. You're paying a sweet, high price for being on this webinar, but that price is being given in your time, and we have a very finite amount of that. So I thank each and every one of you. It's priceless. Thank you, John. So everybody else that's been here more than once, just type in number 2, and you're going to see a wave of probably 100 people coming on, and these are all folks that come back week after week to learn something new. And you know what? This webinar is never the same thing. It's always something new. So I want to give big thanks and shout out to all of those who have come every single week or more than once. We appreciate your time as well. But let's get back to buying a car. I want to try to simply explain to you how the infinite banking concepts works, because I know a bunch of you are brand new. A lot of you, the majority of you know what the infinite banking concept is. You know exactly how it works because we teach it here every time. We go back to the fundamentals, like Michael Jordan dribbling, right? He always started with the fundamentals, the dribble, the footwork, and then he moved up, and he was the greatest basketball player by some accounts, or by all accounts in my case, ever to live. So when we are thinking about the infinite banking concept, the only thing I want you to think about is it is a process, not a product. It is a process that allows you to take back control of your money. But more specifically, it's a process that allows you to take back the banking functions in your life, the banking functions that we have been taught to give away. Now, what are those? Your money. You make money. We've been taught our hour is worth a specific dollar amount because that's what we do. Minimum wage here in New York is $16 an hour. For some, $16 is what their hour is worth. For others, like attorneys, $600 to $700 an hour is what their time is worth. So everybody during your life will have a specific amount that somebody else told you your hour is worth. And for that hour, you are exchanged those dollars. We have been taught that. That's what we've been taught. Okay? But you all know now your hours are priceless. So go to your boss and say, Mr. or Mrs. Boss, my time is priceless, so you're not paying me enough. And you would be correct. They would be wrong in saying, no, we're paying you plenty based on the averages. But the second thing you've been taught to do is you've been taught to give up control of that money. You've been taught to take the money you earn, you've been taught to take it and put it into someone else's account. That account could be a 401k, a retirement account, but more specifically into a bank account. And you put it into a traditional bank account, and they pay you interest on that account, anywhere from 0 to, I don't know, maybe 3-4% today. Okay? You do that. So now let's get into the meat and potatoes of the infinite banking concept. What we're going to do to perform the infinite banking concept, to take back control of our money and to take back the banking functions, is we've got to change two things. One is where some of that money that we put into a traditional bank or a traditional 401k goes first. We have to change who holds that money first, because the bank and Wall Street, they're out for themselves. Make no two ways about it. They're the ones going to make the spread. They're the ones going to be making all the money on that. That's how it works. If they pay you 4%, it's because they're making more than 4%. So back to the car. If you wanted to buy a car and you wanted to pay cash for that car, what you would do is you would take some of that money that you deposit in the bank and you would set up a savings. Okay, maybe you'd start saving $200 a week, $300 a week, whatever it might be. And you would start taking that money and you'd put it into a savings account until you accumulated enough to go pay cash for whatever desired car you have. Let's just say you're buying a $20,000 car. You would save up 20 grand and you would go buy the car. Now let's just say over the course of that period of time where you were saving that money, the bank was paying you 3% on your money, okay? Great. That's not bad for a bank account. How many of you are making 3% or more on your savings or your bank accounts? Put I in the chat. There's going to be some because we're in a high interest rate environment, so it's only logical that some of you are making 3% or more. Great. Yeah, see, there we go. Cynthia, Carrie, 2. There's not going to be a lot of you because a lot of you, if I ask now, how many of you are making 0 on your bank account, checking account? You could put 0 in the chat. I am one of them. My banks that I have money at, except for one, pay me 0 on my checking account. How many of you also get 0 on your checking account? That sucks. But let's go back to this savings account that you're saving, to buy this $20,000 car. You're earning 3%. You've earned interest on that money over the period of time you're saving. You got 20 grand in that account. You identified the car you want. Here's how we have been taught to pay cash for a car. We take the 20 grand, we withdraw it from the bank account. We then give it to the car dealer or whoever's selling the car. They then give us the keys for the car. It's an exchange. The money was nothing more than a means of exchange to buy the car. I now have the car. I got my car, okay? So I feel good. But here's what happened. I took money that was earning 3%. That was a good return on that money in a bank account. And I exchanged that for a vehicle. This vehicle will depreciate in value, as they all do. Okay, unless you buy like a vintage or an old muscle car or an old Porsche or something, the car is going to diminish in value. So that's a pretty terrible thing to do because it cost us money no matter what. If we paid cash, a lot of people are like, oh, I did that because I didn't want a payment. But you actually did have a payment. The payment is the 3% interest that you gave up. The 3% interest that you lost when you took the money out to buy the car. Okay, we all understand that. Now imagine if we changed one thing. We changed where that savings went first. Instead of taking that $200, $300 a week or whatever you were saving to pay cash for the car, instead of putting it in the bank account, we put it into a different account. And I'll just give you that account. We put it into a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Now, I know some of you that maybe are hearing this for the first time, you think that sounds crazy that you would do this, but stay with me. Inside that account, you are earning a gross dividend crediting rate, and I'll just hypothetically say 6%. The companies we work with today pay anywhere between 5.9 and 6.6. That's the going rate between the different companies we have, 5.9 to 6.6. But so I'm just going to say 6% you're earning. Now that's gross. From there, they got to take a cost of insurance, there's a commission paid out, and there's a policy service fee. So you're not actually making 6, but you're making more than 3. Okay, let's just put it that way. So even if you were making 4.5% internal rate of return on your money, that's still better than the 3 we're getting in the bank. But remember, in the bank, when you were getting the 3%, every year you would get a little form in the mail, okay, that was a 10099, 1099, and it said INT. It was basically a tax form that said you have to pay tax on the interest you earned on that 3%. So did you really make 3%? No. You made less because you had to pay tax on that. Over here, we're already making more on our money inside that specially designed whole life, okay? But it's growing tax free. So now we don't have to give up anything in taxes. So we're making more and it's tax free, so we're making a lot more. But here's the thing. Let's fast forward to the point where we save up to 20 grand. Remember in the bank account you took a withdrawal. You lost the earning potential on that 20 grand to buy the car. We're going to do something very similar over here in the policy, except we're not going to take a withdrawal. The insurance company, through a provision, is going to allow us to take a loan against our money. That's right. So we got 20 grand in there. That 20 grand in there is earning a gross dividend crediting rate of 6%. Now, we want to buy the car, so we need 20 grand. So instead of taking a withdrawal, we go to the insurance company and we ask them for a loan. Now, we don't have to get approved for this loan. We don't need a good credit score for this loan. Matter of fact, we don't need anything other than the ability to go in and type it in, pick the phone up and call and say, I would like a loan for $20,000. The insurance company will ask you 4 questions. Questions like, what bank account would you like that to go in? How much would you like? And then, is this part of a divorce decree? And then there's one other question. I don't remember what it is. And then when you answer those questions and click submit, that 20 grand will be sent to your bank account of choice. So now 20 grand within 36 hours is in your bank account, to which you then use that 20 grand to buy the car. Okay? Same transaction, all the same things have happened, and now let's talk about the difference. Remember I said you didn't use your 20 grand. You borrowed against your 20 grand. The insurance company gave us a loan for 20 grand. Now that loan, they are going to charge us interest. Okay? They charge us interest of 5. So remember, and that's a hypothetical rate. It could be a little under 5 right now, and it could be 6, depending on what carrier we're with. But let's just use 5. So if you're earning 6 and you were paying 5, you'd be okay with that. So the cost that the insurance company charges to use your money is offset by what your money is earning, because you did not lose the opportunity for your 20 grand to continue earning interest. This is the breakthrough difference with being your own bank in doing it the other way. Here, your money does not lose the opportunity to earn. And as time goes by, that 20 grand will compound, but it will compound uninterrupted. Nothing will get in its way, because anytime you need money, you can just take a loan against your money. And here's the thing. I want to say this loosely, but the loan never needs to be paid back. The insurance company will never say, send you a thing saying, hey, the loan has come due. They will never ask you for that money back, because the insurance company, what they did is they gave you a loan from their general account. Okay? That general account is there to fulfill on a promise that was made to you the day you got that specially designed whole life. And that promise was that a death benefit would be paid out upon your death. That's what life insurance is, right? It's money when you die. But you see, a whole life policy, especially the ones we design and engineer, is not just money when you die. It's also money while you live, because you just bought a car with that money. So clearly, it's not just money when you die. They allow you to use part of your death benefit, okay, 20 grand in this case, of your death benefit proceeds early. They advance that to you. They give it to you in a loan, and they use your 20 grand as collateral. So you're already way better off. You're earning a higher interest rate on your money, okay? It's tax-free. You can use the money anytime you want without any questions, no credit checks, nothing, none of that bullshit banks make us do, excuse my language. And not only that, my money continues to earn for me. That's pretty freaking cool. That is the start of the infinite banking concept. Now, you can replace the car with your house. You can replace your house with an investment property. You can do any investment or anything with the money. It's just like your bank account. You can use that money in your bank for anything you want. Or you can use the money in your policy for anything you want. But there are some rules. Let's hit the rules. In order to be your own bank, you have to be an honest banker. And this is important. So when you took that loan out for 20 grand to buy that car, the smart person, the smart banker would always repay their bank. And there's no reason not to. Now, let's talk about that. Here's a simple way. If you just took the 20 grand and you figured out what the lost earning potential on that 20 grand was, that would be your monthly payment. You could do it that way. Or you could go online and you could say, hey, what would be the cheapest financing I would have been able to get for this $20,000 car? Oh, $500 a month. Okay, I'm going to make a $500 a month payment back to my policy. I'm going to take $500 that I would have normally given away to a bank for financing or for a lease, and I'm going to put that back in my policy. Now you've changed the game. It already sounded pretty good, right? But let's make it even better. That $500 that you're putting in there, think of it as forced savings. Don't think of it as a payment, because it's not. Because a payment, when you make a payment to somebody, that money's gone from your family. When you make a payment to your banking system, that's a savings, because you keep all $500 of that money every month. $500 that you put into the policy is $500 more you get to use the next day, because you are replenishing your death benefit. You're replenishing that loan you took against your death benefit, meaning the next day you have $500 more to use. But there's another thing that's happening. You're also repaying principal on that loan you took. And remember, the insurance company was charging you simple interest on that loan. You're earning compounding interest. They're charging you simple interest. But now what you're doing is you're driving that APR down, because you're repaying the principal, losing no liquidity, but now you are making a bigger spread. Because if you're making 6%, and let's just hypothetically use simple math. This isn't how it really works. But if you were earning 6 and you were paying 5, your spread was 1%. But if you were earning 6 and now, because of the recapture recycle, the repayment of that loan, you now only paid 4% because you drove that interest rate down, the APR, your spread is now 2. You see how this works? And as you keep doing that, your spread keeps getting bigger, because you are the bank, because you took back control of your money, because you're the one winning when you become the banker. That is the simplest way for me to, without showing you graphics, explain the infinite banking concepts. Now we're going to do a little bit better job, but I first want to start with the transition of your dollars into safe money. The policy is 100% guaranteed. The MYGA, the fixed account that we're going to talk about, the fixed annuity, 100% guaranteed. The SPIA, the single premium or immediate annuity, 100% guaranteed. And these are some of the things that we want to get into, and I want you all to get used to that. I know it's kind of hard to think about saying that word a lot, guarantee, but I want you to get used to it. I want you to start saying it more, because they say in the universe, when we put things out into the universe, those things tend to happen. But we got to consistently and persistently do it. So you got to start saying, I want guaranteed income. I want liquidity and control. I want a legacy. I want tax advantages. I want tax-free growth. And I want to be my own bank. You got to start saying these things, because if you're not saying them, you don't actually mean it, and you don't actually want it. The universe and your mind doesn't know the difference. If you don't say it, if you don't put it out there, your mind doesn't, it just keeps doing what it's been doing. And what you've been doing up to this point, I'm not going to say it's not working, but it's not working the most efficient way. Today, I want to show you that efficient way, and I want to show you how to park money in a better place. And Mark Perry asked, what is the difference between a MYGA, which is a fixed annuity, okay, just a bare bones fixed annuities. We don't do any of that index crap over on this part, and a SPIA. MYGA means multi-year guaranteed annuity. Okay, SPIA means single premium, so that's the difference, multi-year versus single premium immediate annuity. Now, really, the only thing to understand is two things. The MYGA is deferred. You put money in it, it's growing, and it's tax deferred till a later time. Think like a retirement account. You're going to grow tax deferred for a period of time in the future. The single premium immediate annuity is you've got money now and you want an income immediately. So you put money into that SPIA and it starts paying you an income out immediately, within 60 days, whenever you choose. It could be literally in a week from when you choose, but it's an income annuity versus the deferred annuity. So that's a good question. The other one, so if my policy premium is $330 a month, I can pay $500 a month, increase the cash value faster. Tanisha, that would kind of really be case by case. With the way we design them, the answer would be no. You wouldn't be able to jump from $330 to $500 because we build them within the IRS rules so that they remain tax-free. And if you went from $330 to $500, you'd probably MEC the policy, which today we're going to show you how never to MEC a policy with single premiums. But Tanisha, I think it would be worthwhile to kind of book a call or maybe ask kind of a question, but you'd have to be careful. And if your policy doesn't allow for that extra money within your funding limits, then you would have to start a second policy. All right, Craig, turn it over to you.
All right. Let's see. There's one thing I was thinking of hitting on just on the basics of infinite banking before we jump into it.
Hey, Craig, while you're rearranging it, one other thing I want to say is, remember earlier I had mentioned about the MYGAs. So if any of you, and I'm sure some of you are probably going to be interested, if here are the rates, and I can kind of show it right here. This company, and is an A- rated company, so it's one of the good rating companies. They are paying 5.6% guaranteed for a period of 3 years. Or you could do 6.3% for a period of 5 years. Or you could do 6.5% for a period of 7 years. So at these rates, I think it'd be silly not to do the 5 or the 7 year, because you might as well lock in that rate for as long as you can. Because I guarantee you in 5 years, when it comes off that rate, you're going to be sitting there saying, boy, I wish I could have done this for longer. So go along with it. The caveat with this company is it's got to be $100,000 or more. So in the description, what we're going to do is we're going to put an 800 number up there. If you want to speak to somebody about that, you can do one of two things. You can call the 800 number, which is 866-329-BYOB. I'll have Stephen throw it in the chat. You could just give us a call, and we can kind of walk you through this and other options with the MYGAs or the SPIAs, the fixed annuities or the income annuities. We can walk through your options, or give us your phone number, and you can do that either in a private chat, to the host or to me or Stephen. And then what we'll do is we'll reach out to you and have somebody from our annuity division, because we have a specialist who's an annuity specialist that can actually help you with that. Sorry, Craig, just wanted to throw that out there, but go ahead.
No problem. I was just going to rewind a little bit talking about the case where you're buying a car. So you kind of shared the whole strategy of taking loans, using savings. When we talk about infinite banking, especially when you're thinking about your money going into the savings account to save up for something, then you buy your car, pay for windows, whatever that's going to be. This is what it looks like, and this is what most people experience throughout their life, where they save up money in a savings account. When it's time to go buy that car, they take it out of the savings account, we're back to zero. So the cycle we see people going through their whole lives is save your money up, spend it, save your money up, spend it. Now that's a drastic picture, but that's somewhat of reality where we're always kind of ending up at that zero. And so the other way you could think of buying a car is to borrow the money. So maybe I need a car right away, so I'll borrow the money and I'll spend the next 5, 6, 7 years paying it back and working my way back to zero. My next car, I'm going to borrow and pay back. So whether I'm saving and spending or whether I'm borrowing and spending, we're always ending up at zero. The easy picture for the infinite banking concept process is what if we were to take that same amount of savings and it just continued to grow and it just kept going and going and going, regardless of whether we were using it to buy cars, to, pay for vacations, whatever that is. But the cycle that you're seeing here is that money is actually starting below the zero line because there's some efficiency periods we need to get over. But once we do that, that's just going to continue to hockey stick on up for the rest of our lives. Now, what we're going to do is we're going to borrow that money and pay it back, borrow that money, pay it back, borrow that money, pay it back. But would you rather, say, 5, 10 years down the road be over here or be here at zero? So that's really the thing I just want to add on to the basics of infinite banking, why we do what we do. That continuous growth is really what we're after. And as Chris mentioned, the word guarantee is in there, but we also have that non-guaranteed dividend piece. So anyway, I just want to share that. Hopefully that was helpful for some of the newer people that are joining us today. Let's talk about these different things that are out there because we do have situations where people say, "Hey, I've got some extra money. I've got 100,000, I've got 50,000, I've got 30,000. What do I do with this pile of money?" And we can look at structuring that in different ways. So for example, there's something called a single premium whole life insurance policy. You could literally take that money and just go put it into that policy day one. You would no longer have to put any more premiums in. You funded it once. However, as Chris shared already, it comes with the fact that it's a modified endowment contract. So you will have some taxable consequences inside of that structure. So we have single premium whole life policies. They can be used. I'm going to actually show you a comparison of using a single premium whole life policy versus a SPIA feeding a policy. But we have these other things. Chris, you already kind of touched on deferred and immediate annuities, but I think it's worth kind of mentioning what these things are. If you have an IRA sitting in, let's say Schwab, for example, what could you do with that? You could move it to a self-directed IRA where you could then have more controls over what you may want to invest in. So let's say it's with Schwab or Fidelity, they're going to give you a set of stocks and bonds you can invest that IRA in. One option is to move it over to self-directed. You can go put it into real estate and other things. But there's another option where you could potentially move that qualified money into a deferred annuity, let it grow over time, and then at some point turn on an income rider where if you want that guaranteed income for the rest of your life, this is a really good strategy. I actually did this for my mom. Oh, let's see. She's now 82. So when she's back in her 60s, we took a couple of her retirement accounts, put them into some deferred annuities. And when she was ready, she turned on the income. And she has guaranteed lifetime income, just going to keep on cranking along. So we don't have to worry about how the bills are getting paid because those checks just keep showing up. So that's a pretty strong strategy for moving some of that qualified money into, deferred annuities. The other structure we can talk about are immediate annuities, which, if you want to take a chunk of money, put it into an annuity and then start the income stream right away, that would be the immediate annuity. And then I also want to touch on different whole life insurance policy structures where has anyone heard of 10 pay? And essentially what you're doing is you're structuring the policy so that you're fully paid up in 10 years. You're going to pay premiums for 10 years and then you're done paying that. That can work well for kids' policies. That can work well for someone that might be, 10 years from retirement and they don't want to continue putting in premiums. So those are some different structures. And then I also have CD laddering in here. When we have people that have lumps of money and they want to maybe sprinkle it into a policy over time. Annuities away, you could do CD laddering, of course, all the things that Chris shared about being taxable. The rates are going to fluctuate quite a bit, and CDs aren't all that exciting right now, but these are some of the things that we have to play with. So, Chris, I was just kind of running through some of the different structures where you had a pile of money, you could run those into like a CD laddering structure or a single premium whole life. So, I don't know if there's anything else you want to add to that. Otherwise,
No,
we'll.
just Mark was asking, can a company purchase a MIGA? Yeah, companies buy them all the time. And they do it because they've got money in reserves or they got money that just sits there that they just want to grow, but they don't need it today. It's for, a reserve. That's a perfect use for it. So 100%. Any company for any use case, and there's really very little underwriting. It's just a suitability underwriting. Any company or individual can buy the MIGA, the fixed annuities. Very simple application process. And then Marcia said, this is actually for Craig. Can I find out more about what you just mentioned you set up for your mother and how and not wait, it's a little word, but little wording.
How she has income. Yeah, so it basically what she had is old 401ks that eventually turned into just some IRAs at a brokerage house. What we end up doing is turning those into deferred annuities. And so though that money moved, it's still qualified money, so there were no taxes by taking it out of the IRA and putting into the deferred annuity. The idea would be it would sit there and grow over time, and when she was ready to retire, she flips on what's called a lifetime income rider. Now you can put cost of living adjustments, all these other things on those plans, but essentially what we did is we annuitized that qualified IRA money into an annuity. And let's say you put 100,000 in there and you live to be 100 years old. Well, they have to continue to make those income payments every month. So we don't worry about the fluctuating income with the stock market. It's just that check shows up every month and it has for almost 20 years. So that's one way to think about how do I have income throughout my retirement that's predictable. And you definitely want to think about what do I have on the guaranteed side and what maybe am I using off of my investment strategy. So we may have some of our money out there still working in investments, hopefully we're having gains, but look, at the end of the day, that stuff can go down as well. So we want to think about how do we cover our housing, our food, all of the things that we need to get by, and maybe we have enough guaranteed income to satisfy that part of our lifestyle. So that's where the annuities are very powerful, is it's going to create those lifetime income streams. Or you might say, I only need an income stream for 10 years. So you can kind of structure that however you would like. All right. And Chris, I wanted to throw this up there just because I probably captured a bad picture, but you did a wealth webinar a while back and it talked about the volatility buffer, the covered asset. And again, these are strategies where you can use whole life, you can use annuities, along with your market-based assets like a 401k, or maybe you have some stocks. At the end of the day, when the market's down, we want to look at what other tools can we go to pull retirement income from. And the volatility buffer, the tool there is a whole life policy where market's down, we'll take money from our whole life policy. When the market comes back up, we'll stop taking money from the whole life policy. The covered asset is a strategy we use with annuities where, again, I'm covering some of my basic costs with that annuity, with that guaranteed income.
Craig, I can sincerely say this is like for anyone who's, looking or thinking about retirement or planning for retirement or already in retirement, this is a must-watch video because as you can see in that little screen behind me, retirement income, when people are planning for retirement, these are the things they're concerned about. They're concerned about the volatility of the markets. They're concerned about outliving their money. They're concerned about what about taxes if they go up, or what about the sequence of my returns? That's called drawdown effect. It's a very real thing that not enough financial advisors are talking about. Healthcare is not getting cheaper. So what if healthcare keeps going up? That's going to erode my retirement income. Inflation, same thing. So These are all things that people look at every day when they're thinking about retirement. And they just, a lot of times the advisors are just not giving them the most efficient path. But this video outlines how to literally erase all those risks from your retirement, how to, you know, protect yourself against volatility, how to cover the covered asset strategy, I think is phenomenal, but also how to layer in infinite banking into the whole thing. It's literally just changing two things to your retirement. And those two things literally bulletproof your retirement. So you don't have to worry about any of those things anymore. You just worry about living your life, enjoying your retirement, and the checks keep showing up.
Yeah. And it's definitely a must watch for preparing for retirement and getting yourself positioned in a much better path than, we're taught. And so I always like to share that one. What we're going to talk about now is kind of the meat of the subject. Imagine this is the setup. You have $100,000, maybe it's inheritance, who knows, maybe you sold a company, whatever it's going to be. You have a pile of money. The amount doesn't matter. Make sure you kind of understand the process. I used 100,000, but maybe it's 50, maybe it's 200,000. And what we're looking at doing is putting that money into a safe guaranteed place, and then we want to take another step and use it to fund a whole life policy. And sometimes I'll see it doesn't have to be necessarily a single premium immediate annuity, but if you had some retirement funds, you put into a deferred annuity, and at some point you turn that on, that money could then fund a whole life policy. But the real question is, why would you want to do that? And in the case where you might be in retirement and you're looking at the situation of that IRA or that qualified money is going to be transferred over to the next generation with a big tax bite taken out of it. Or we can start to withdraw that thing down and run it into a whole life policy where we're getting into a tax favored environment. That death benefit's going to be moving over to our family tax free. And it's going to be multiplied because we're taking that premium and we're multiplying it with the death benefit. So it's a really, really good estate planning strategy if you want to minimize the taxes going to the next generation, as well as bolster how much is going to the next generation.
I think an important thing to talk about here, I know you're showing it funding the 10 pay whole life policy, but if everybody could just focus real quickly on like this is an example, and I know Craig, you just updated this with the new rates. This is somebody that had $100,000. Okay. Your dollar amount might be different, but just use 100 grand. Look right over there, the annual income. It's $11,667.83. If you divide that into 100,000, and they call this the payout rate, that's a guaranteed. And I want to preface this guaranteed because it is. It never will change for these 10 years. A guaranteed 11.66% payout rate. Like that is absurd. Like most people don't even make that in the stock market with lots of risk. And here you can do this 100% guaranteed. This is the SPIA. I mean, this is what they do. But like I said earlier, right at the very beginning, like I don't see this lasting. I haven't seen these kind of payout rates or these kind of interest rates in 20, well, I don't think I've seen them once in 23 years. It's just insane. But these are not made up numbers. These are not Dave Ramsey magical mutual fund numbers, although close, because Dave Ramsey's magic mutual fund is 12%. And just so you all know, that doesn't exist, but he thinks it does. But this is 11.66% guaranteed, no magic needed, no volatility that is part of this. It is just that is the rate.
So what's happening is we're taking that 100,000 and we're sprinkling in money into the whole life policy for 10 years. So it's now on autopilot. You're not necessarily having to do anything. This money is just working in the annuity. It's then funding the single premium immediate annuity. You're paying the taxes out of the distribution, but the rest of it's going into premium. And so that's how we're transitioning that 100,000 into the 10 pay whole life. Now let's jump in and look at this. I know this is a wall of numbers, but what I wanted to be able to share is just the fact that every year you see this $11,000 premium going in. This is on autopilot. Every year we're going to get that $11,000 distribution. We're going to use that as our premium. Once we get to year 11, because this is a 10 pay policy, we're no longer putting in any premiums. So the policy is paid up. You're now at a point where you have $128,000 of cash value and a death benefit sitting over here about 363,000. Now, this 128,000 is available to use as loans. You could withdraw up to $110,000 tax free. Anything above that would be taxable. But think about all the things you could do with this. And when you go back and watch the video that I posted about Chris's volatility buffer and the covered asset, start thinking about, well, if I have some stock-based assets out there, market's down, I now have $128,000 where I can go tap into that when I need to, and then quit using it when I don't need it, and then just go back to my market based. That's really what the volatility buffer is about. But now you've got this asset, and every year you see this cash value growth column. It's just going to keep going, 6,381, 6,681. And it's just going to keep growing and growing. And it's going to do so whether you're taking loans from it or not. So it's a really powerful asset to have inside of when you're at that point of retirement. And then from a legacy perspective, you've put in 110 and you've multiplied the death benefit over here if, God forbid something happens to you in that time frame. So that is path number one of using an annuity to fund a 10-pay whole life policy. So what I want to talk about briefly is there's another path, and sometimes people say, well, why wouldn't I just take that 100,000 and just put it into a single premium whole life policy? So let's talk about what a single premium whole life policy can do for us. Well, it's one-time payment, so that's kind of nice because we just make one premium payment. We don't have to think about year 2, 3, 4, and 5, 6, and 7. We immediately have the full coverage of that 100,000. So think about that 100,000 going in, creating a bigger death benefit than what we just saw with sprinkling it in. We have that cash value accumulation. There's some tax deferred growth, but we have to think about when we take loans past cost basis, or if we do withdrawals, there could be some taxes there. It's still liquid. We have access to that cash, so we're not losing liquidity. And the policy is paid up, so we won't have the issue of it lapsing. And so there's just a lot of benefits to doing it, but it has to make sense. It has to be used appropriately. This is not necessarily the path we go for building an infinite banking system because we typically want to keep our premiums going in there and using that to build our system. But this can work well for a lump sum of cash. Let's take that same 100,000 and you see it all going in one chunk. I have a death benefit over here of 193,000, but I'm putting that in once and then I'm no longer having any premiums because this is just one premium going in, it's all paid up. My cash value is 150,000. And if you remember from the annuity, I think it was 128. So you might say, well, wait a minute, this might be the better route to go. But we also have to consider the fact that we have some taxes if we take loans and we do any withdrawals. But it's an option. And in all of these different strategies that we're talking about, I can't just tell you, just go do this one or just go do that one. It takes some strategy, and we need to have discussions about what you're trying to do, what your specific situation is, but there are options out there. So here I just want to kind of wrap up with this last example of over here, we have the single premium whole life policy. Over here, we have the annuity. Remember, we put the 100,000 into the annuity and then had it funnel that money into our whole life policy. The gain at year 10 is $50,150 in the single premium whole life, but it's only 28,000 when we ran it through the annuity. So you might just stop and go, well, case closed, single premium whole life is the way to go. However, we have taxes to deal with on the single premium whole life past our cost basis. So we would have about $12,537 of taxes, assuming you had a effective tax rate of 25%. Now that's going to vary. Plus, if we are doing any withdrawals before age 59 and a half, we could have some additional penalties on top of that. So what I want to look at here is what's the net benefit. So I have the gains, take out all the taxes. Our net benefit at year 10 is about 132,000. Now let's go compare that to the annuity strategy. We don't have taxes on that, but I do have a little asterisk here saying remember we paid taxes when the money came out of the annuity. There were some taxes on the growth there. But once that money is in the whole life policy, there's no taxes. And so we're really almost neck and neck here, where we've got 132,000 of cash value versus 128, which is the net. You may want to consider what things look like in 15 years, 20 years. And that's where, I want to say this is not the case closed, because we want to think about what else are you doing with this? How does it fit into your legacy plan? The annuity might be the way to go. The single premium whole life could be the way to go. But the good news is there's options. You have options out there.
I think it's really a two-part system here. Number one, you got the infinite banking concepts. That's like the ecosystem, right? That's the foundation where the money starts. The annuities, whether it's the MYGA or in this case the SPIAs, they're really just a fuel source. They're a potential fuel source that gives you a guaranteed result without any thought, concern, or really anything. There's zero risk. So I think that's just a good way to look at it is, the two work very well in conjunction with one another. Now, I know we've done a bunch of trainings where we've taken lump sums and we've gone into private lending deals, and that works too, right? And we always used to show that because it was like 10, 12% on the private lending deal, and then we took that 10, 12%, we would use that to fund the policy. But right now, this again, because it's such a unique time with the interest rates, you can almost get that same 12% in a guaranteed fashion, like you just saw, and just have it do the same thing. So it's just a different way to do it, but it just cuts out and eliminates any potential risks that would be found in any other risk-on asset strategy.
Yeah, and Chris, I'm glad you mentioned using the investment to sometimes fund these other things we want to do. I would caution everyone to kind of take an approach of looking at your own situation and think about when you get to retirement, what are the living costs, the food, just like the basic things that you need to cover. And this is kind of how I think about it too, is if I lost everything, would I still have a place to live, food to eat, and a TV to watch? That's what my guaranteed income should cover at a minimum. Now, I like guaranteed income, so I might actually have more than that. And then it gives you more flexibility to go out and do some of the investment strategies. But if we don't have our guaranteed side taken care of, then we probably shouldn't be going real aggressive on our investment side. That's just the world according to Craig. Don't have to agree with me, but that's just how I roll. So with all that said, Chris, do we have any questions that we need to touch on before we move on to?
I was just answering one that was over in the Q&A about,
Yeah.
that last one they were confused. Is this a comparison between the single premium whole life and the SPIA? And my answer was yes, but it's not a comparison against the whole life or the single premium whole life versus the SPIA. It's the single premium whole life versus taking the same dollars, putting them into the SPIA, having that fund a 10-pay, specially designed whole life. So really just kind of looking at two identical things with the same dollars, accomplishing the same goal.
Yeah, and I would say the takeaway, don't get so worked up on the numbers per se of what we showed. Walk away with the idea that there's options. You could do the single premium immediate annuity to fund a whole life policy. You could put all into a policy. You could structure multiple years of premiums. And which one's right for you is going to depend on a discussion and a strategy call of what you're trying to accomplish. And then we may say, hey, I think this strategy over here would be the best for you. But there's a lot of different options out there. A lot of
Yeah,
options.
I think the days of having to choose between safety and control are over. Like you can have both of them now, and you can. The other thing too that I want to preface, was earlier we were talking about the MYGA, the guaranteed fixed account. That for 3 years you can get 5.6, 5 years 6.3, 7 years 6.5% on $100,000 or more. I think a really good strategy for this for the MYGA, different than the SPIA, I want to be clear, this is a different deferred strategy, is if somebody was saving for retirement, they had an old 401k laying out there, or maybe you've got money in an IRA and you're just watching it ping pong around, you're like, I just want off of this. This is just me, okay? But I can make this recommendation. If it were me, I would be jumping at this opportunity to roll my IRA or my 401k over into, and it would still be an IRA. You're rolling it into the same thing. It's still an IRA, but it's a guaranteed IRA return now. So 6.5% for 7 years. I mean, shut the front door. I don't mean to keep saying that, but like, I can't preface like how high that is. For 7 years, you make 6.5% guaranteed on your money. Hell, even if somebody had like, let's just say somebody had a $300,000 retirement account, right? Split the difference, like take half and half, 175 and 175. 175 stays in the advisory account, roll the other 175 into the guaranteed account. Now what you've done is you've diversified against loss on half of your retirement. And you can still take the risks in the market on the one side, but the other side, you just know what it's going to be worth. You could literally just grab a calculator and be like, all right, I got 175,000. If it grows at 6.5 and boom, you know exactly how much money is going to be there. No ifs, ands, or buts. And then, anyone else that's got money sitting in CDs or sitting in bank accounts, I mean, like, seriously, like, come on, no. We don't have to have the conversation face to face where I'm like, really? Like 6.5 or 6.3%, whatever one you decided based on the duration, on lazy money sitting there in a CD or in a bank account? Like, that's a silly one. And I love that Mark brought up using it in business scenarios, because I know a lot of business owners right now that are sitting on tons of cash. They're just sitting on it and they want to do something with it. So put it here. Like, this is a great way to shield it and have that money work. And just so you all know, like, we're not saying annuities versus IBC. Like, we're putting the two together. You need both, but they're both doing something different. They really are. So I think that's important. So again, if anyone's interested, you can either give us your number and we'll set up a call with you to kind of walk through your options. And again, if you don't have 100,000 or more, great. If you got 10 grand, there's options at 10 grand. I got all the rates right here, and they go down. I think the lowest is 10 grand, if I'm not mistaken, right, Brian? 10 grand. So anything from 10 grand and up is game for the MYGAs. And there's the phone number. I just put it in the chat again if somebody wants to do it. But Stephen, let's have you wrap this sucker up talking about the blueprint, because everybody was like, I want a hat or I want one of those decks. So why don't you take it home from there?
To show you guys real quick, it's the 3-day BYOB blueprint virtual training, May 28th through the 30th. So it starts next Thursday morning, coming up quickly. There's two options. You can get a $47 GA, but the 97 VIP is really what you want, because it gives you the recordings. It'll give you access to both the bonus sessions on Thursday and Friday afternoon. We also will send you a special digital gift package, and you have priority Q&A. So the recordings are probably the best part about that, though. So you can go back and watch them over and over again. If you want to learn more about what's going on, we do. Chris and I think, Craig, we stand behind what we teach 100%. So if you don't like any part of what you learn, or you're just like, that was kind of, I didn't really get any value out of it, just email me on Sunday or Monday next week, whatever, and we'll give you your money back, no problem. But I know you guys are going to love it. Everyone always does. Actually, about half the people end up coming back and buying a ticket for the next one. So it's pretty cool to see that. So you could go down, read through here, learn out a little bit more, what we're going to be covering, what that looks like. But at the end of the day, we're trying to make sure you have a crystal clear money management system you can start using immediately. So we're going to create a blueprint plan for you. You can have a blueprint strategy call from the call to go over it, make sure everything's set up and you know exactly how to take action. You have confidence using infinite banking, keep more of the money you're making, and give you that peace of mind. The way I look at it is it gives you that clarity and confidence to be able to go out there and make things happen. So you can see some of the different speakers, people that'll be on. So it's gonna be a fun few days. Looking forward to it. But that's it. So you guys can introduce Brian. Introduce yourself, just so they know who's going to be calling them.
Yeah, hey everybody. I'm Brian Fouts on the mentor team here, BYOB, and myself and Tess, who's also in the chat here. We actually are the annuity side of this, as well as infinite banking practitioners. So yeah, so we can talk with you about how you can use one or the other, or work them together and do that. And Mark's got a great question here about annuities, because they're pretty versatile, just like infinite banking, and they can work together very well. but he's referring to a multi-year guaranteed annuity. And is it reinvested or paid out at the end of the term? So if you have like a 5-year multi-year guaranteed annuity, it's going to pay you a guaranteed return for that 5 years mark. At the end of the 5 years, it's up to you. You have option. You can roll it back into another multi-year guaranteed annuity. Maybe you can do it into an instant income annuity. You can roll to an IRA, solo 401k, because it's considered qualified money. That's why. And so I have a great case study. Actually, this was earlier this week. A young gentleman, he's in his 20s. His father passed away unexpectedly, and he got an IRA over $100,000. But he's like, what do I do with this thing? I don't need the income. I don't need it next year. I don't need it. What do I do with it to lock it up? We're doing a multi-year guaranteed annuity for about 5 to 10 years. He's going to guarantee the growth of that thing, and just keep rolling it. And then every 5 years, he can choose to keep doing it. And then once he hits retirement age, instant income guaranteed. So can work with a lot of different strategies.
Let me add on to that for Mark. There's also the interest that you're paid. I mean, that's a daily interest that they take that, we'll use the 7 year, 6.5% annualized, right? But they're calculating that every day. So what a lot of people will do is they'll set these up, could be, qualified or non-qualified money, retirement or non-retirement dollars, and they'll set it up so that they get the interest that they earn paid out to them on a monthly basis, like an income. If you're doing this for income, the SPIA is going to be a much better choice. But if you're doing this to grow the deferral, but you're just like, hey, a little extra income right now would help, the insurance companies, not all of them will do this, but most of them will pay out the interest. Some will allow monthly, others are like semi-annually or annually. It just depends on the company. But you can structure it that way, or you just have them reinvest the interest. So like Brian was saying, at the end, you've got the 100 grand plus all the interest that you earned over those 7 years, and then you could just roll it to the next one because they do mature. Okay, so after 7 years, what would happen is your guaranteed 6.5% rate will end. And then there will always be a floor rate, maybe 2 or 3%. So if you did nothing in that 7th year and you just left it, it would reset at whatever the guaranteed rate is in the contract and continue until you roll it to the next one. Now, what might happen, I can't predict this, but we're in such a crazy time right now. What very well could happen is you might get to the end of that 7 years and rates actually might be lower than what your locked in guarantee is. So then you would just keep the guarantee that's on there and just keep collecting that until rates go higher and then move it into a higher guaranteed annuity. We do this all the time. I literally have gone several full cycles of this, and it works really well for people. And usually, here's the other thing, Brian, you see this in test too. When people start doing this and they start getting used to guaranteed returns on their money, I very often see them go back to market-based stuff, at least with the majority of their money, because they get so used to just a guaranteed interest rate.
Yeah. And someone else was asking about the MIGA. It's kind of weird acronym, MIGA. And they said, well, I have an IRA. No, it's a 401k from a prior employer they didn't roll over to their current employer. They're saying, hey, would it make sense, and once again, not giving financial advice here, to take it out of the 401k, which is volatile, tied to the markets, no guarantees, at risk, and roll that into a MIGA. Guaranteed growth, guaranteed, time frame, because they don't need that. They're in their 40s, by the way. And so that's what they're doing. They're going to take it out of the volatile 401k and move it over to a guaranteed environment and get guaranteed growth. So yeah, they were blown away. They were blown away, Chris, you'll probably appreciate this, that their financial advisor didn't even mention this. Gee, I wonder why.
The other thing too, let me get something out of the way here. And if any of you have financial advisors and your advisors never brought up like the fixed annuities, they probably would love to sell you variable annuities. It's because the fixed annuities, remember I said there's no fee. So the commission, as you can imagine, what we get paid is super freaking low. But it's not about the commission, but the variable annuities, and if anyone ever has questions about indexed products, indexed annuities or indexed life insurance, and why those are so prevalent, why that's what every advisor wants to talk to you about, the commission on a fixed indexed annuity, which they will tell you is a guaranteed annuity, which it is, but it's indexed, so your return is tied to the index, not to a guaranteed interest rate like what we're doing. The commission is more than double. So you please try to explain to me how like the one we talk about, the MYGAs, versus the indexed annuities, which are both guaranteed products, why one pays double a commission. Who's paying that commission? You are, the client, because the risk is all on you. The risk is not on the insurance company. So they entice advisors to sell the index products by paying them more. Indexed universal life is no different. It pays way more than the whole life policies we sell. And you wonder why they're so prevalent. It's because they're getting paid more to sell them. That's why. But you're probably not going to get an advisor that's going to sit there and be excited about MYGAs because the commissions suck. But you know what? It isn't about the commission. It's about what's right for the client. And I can't help myself to believe that 7-year locked in 6.5% interest rate isn't good for the client. That's freaking great for the client. And it doesn't matter what the commission is.
Don't forget assets under management, the 401k.
Absolutely. Yeah, lobsters.
Yeah. If your 401k is under a certain advisor, they're going to get that fee every single year forever until you no longer there.
Love it. Well, folks, we hope you enjoyed today's wealth webinar. It was a lot of fun for us to put this together. Craig knocked it out of the park with those examples. But, you know, it just drives the consensus that it is not worth taking excessive risk right now when you can get paid so much for sitting on the sidelines. And for sitting on the sidelines, then you start becoming your own bank. That's where you're going to make the majority of your money. Just take back the banking functions. Just take back all the interest you're giving away to everybody else. You do that with the MYGAs and the interest rates where they're at today, you are rocking and rolling. And most people will look at you and be like, wait, you're getting how much guaranteed? And you're just like, yep, you should have been on the webinar. But they weren't, because they weren't part of the 5%. They didn't want to invest their time into learning something new. And that's a big problem. Will Rogers said it best, and I'll close with this. He said the biggest problem in America, and I think this is the biggest problem anywhere, isn't what people don't know. He said the biggest problem is what people think they know that just ain't so. Stop thinking you know everything, because things are out there that most people don't know about, most people won't talk about, and they're there for you. And that's what we're trying to bring to the table. And hopefully you enjoyed it all. And hopefully I'll see a whole bunch of you at the 3-day Blueprint event. I know some people just got skateboard decks, but a bunch of you are getting some hats. So I know Stephen took care of telling you how to get your Haters Need Hug hat, or BYOB hat. Very similar to what me and Stephen are wearing here. But with that being said, thanks for joining us. And we will see you on the next wealth webinar.